Hello, everyone. Thank you for joining our quarterly NEPC webinar. For the next 30 minutes plus, we will be walking through the changing market dynamics of the last quarter and outline also some of our market views. First, just some logistics. We'll take questions at the end of the prepared comments. And if you do have a question, make sure you type it into the question box in the lower right hand side of your webinar. So with that, I'm Philip Nelson, Director of Asset Allocation, and I'll be walking through some of our views. But first, we're going to kick it off with a colleague of mine, Jennifer Appel, who's going to get us started with a look back on the second quarter.
Thanks, Phil. So I thought we'd start today with a broad overview of the second quarter, where we saw risk assets, including equities and credit, add to sizable gains that they had from the first quarter, and also a corresponding rally in safe haven assets as global yields declined, which we'll explore in a little more detail in just a bit. And a lot of this positive performance across different asset classes was driven by a shift in major central banks to a more accommodative posture in acknowledgement of a weaker global backdrop from escalating trade tensions between the US and China. It's now likely that we're going to be looking at some rate cuts by the Fed and even further stimulus from the ECB, which would likely help to dilute some of these ongoing concerns and potentially even work to extend the US economic expansion even further. So within equities, while most global equities have done quite well so far this year, the US has continued to lead the way. If we look at the S&P 500 index, the US had a really stellar start to the year, logging the best first half for the index since 1997. And this idea and chart on the screen is not really meant to imply any specific level of return for the second half of the year, but it's more of a reminder that historically, when the first half has been so robust, like many of the years you can see in the late 90s, the second half is likely to be more muted. And this is really at the heart of our message to rebalance developed market equity exposure, which Phil is going to talk about in just a couple minutes. So while equity markets seem to be implying a fairly robust market environment, the bond market's telling us something pretty different. From a rate standpoint, expectations for US rates have shifted pretty dramatically since the beginning of the year. And as we look back to December, plotting the market's expectations using the Fed Funds futures in blue versus the Fed Open Market Committee, or FOMC, in green, we can see there was clearly a discrepancy in expectations at that point. The Fed was anticipating a few hikes for the next year or two, while the futures were saying maybe one, but really a much flatter picture. And as we fast forward over the next 6 months, both the Fed and market expectations have gradually come down, somewhat reflecting a deterioration in sentiment over that time period. So now with the solid line showing June 2019, we're seeing expectations for Fed cuts, with the market more dramatically implying maybe 3 or 4 rate cuts over the next year or two. And that pivot in expectations from rate hikes to rate cuts is really significant, and it's clearly had a large impact on capital markets, as we've seen by the performance numbers, for example, we just saw in the previous slide. Now, if we extend this to look at other areas of the fixed income market, we can see declining yields throughout much of the developed world, which is somewhat unusual given that typically when you see a risk asset rally, you'd expect that maybe there's some bullish news or positive economic data underpinning that, which would push global bond yields higher. But instead, we're experiencing just the opposite. And a lot of the decline we've seen since the beginning of the year is repricing lower economic growth in 2019 and beyond, causing a flight to quality as concerns over economic activity are increasing. And falling rates has become really the main story for global bonds, causing many developed markets, specifically in Europe, to become, for lack of a better term, infected with negative rates. And even countries that aren't in negative territory, like those on the bottom of the screen, are experiencing nominal yields that are close to or even at all-time lows. So while we're not constructive on global developed government bond exposure outside the US, and frankly, we haven't been for some time, This is a helpful data point showing that there are real concerns about economic activity out there. Now, to bring us back to the U.S., we haven't been immune from that declining rate directionality we've seen. And really, over the past 6 months or so, we've seen significant movement across the curve. So the short end, as you can see from the 1 to 6 month range, hasn't moved as much. And this disproportionate movement across the curve has caused concerns over an inverted yield curve. And if you've followed our materials over the past year or so, you're probably aware that we tend to focus a lot on the yield curve and specifically two spreads within that. So one being the spread between the 10-year and 3-month points, and second, the spread between the 10-year and the 2-year points. But the important takeaway being that historically, an inversion at these spreads has been a reliable indicator of an oncoming recession, but unfortunately, there's little clarity about that lead time up until a recession. Interestingly, throughout much of the last quarter, we saw an inversion happen between the 10-year 3-month points, but we've yet to see that 10-year 2-year fall into negative territory yet, which is the metric we're actually a little more focused on. But more recently, that 10-year 3-month spread has gone into neutral territory. And also in thinking about the Fed potentially cutting rates, some of the concerns about an inverted yield curve seem to have subsided. Now, another factor in this narrative of declining nominal yields is the broad decline we've seen in inflation expectations around the world. So specific to the US, if we look back over the last 20 years or so, for the median CPI number, that's been a little bit above 2%. And since late last year, we've seen a pretty steep decline in inflation expectations, which you can see in break-even pricing or market expectations, as we've shown using the 5-year forward inflation rate. Both of these indicators are suggesting that the market's really not concerned about meaningful inflation at this point. And if anything, potential deflation concerns could be starting to seep in. And finally, rounding out the fixed income landscape, just a quick comment on spreads. Unsurprisingly, since equities were up, we saw a pretty healthy decline in credit spreads at an index level. However, if you look at the lowest rated bonds, which we're showing using triple Cs and below, the spreads in that area actually increased, reflecting that investors are demanding additional yield to hold on to those riskier bonds. This kind of makes sense to us given our view that we're in the late stage of an economic cycle, as these lower rated bonds are likely the most vulnerable to any type of economic weakness that might show. But I think this is all just reiterating the fact that we're not seeing a ton of good risk-adjusted opportunities in the credit market today. So to switch gears a little bit, I've mentioned some concerns about global growth underpinning a lot of the market movement we've seen thus far this year. One data source we frequently look at, along with many other investors, is the IMF for economic growth forecasts. Earlier this year, they came out with their growth forecasts, and a lot of them had been revised downward as a reflection of the impact of tariffs on trade and investment in many economies. And actually, just this morning, they announced updated estimates, which we're displaying on screen. So this is showing the difference between the April estimate versus the July estimate. And as you can see, many developed economies, specifically the US, have increased compared to the numbers they were expecting back in April, given a stronger than expected start to the year. The largest downgrades, on the contrary, were in emerging markets, given their exposure to trade and reliance on China, whose economy is already in the midst of a structural slowdown. And if we take a closer look to Europe, the previous slides showed no change to the IMF estimate since April, but on a year-over-year basis, the growth estimate has declined quite significantly, showing that the region hasn't been immune to a lot of these concerns I mentioned about trade or a China slowdown. The unfortunate difference for Europe is that on top of a lot of these more global concerns, there are also a number of idiosyncratic risks at play, such as Brexit uncertainty, manufacturing weakness in Germany, debt in Italy, and you can kind of keep listing out a few other things. These endogenous factors have created a more fragile environment that makes this region a little more susceptible to tariff, and trade concerns, which have already clearly impacted sentiment and growth. And as trade tensions escalated through the past year, we've seen and felt the real impact on a global scale. Looking at the U.S. trade profile, we can see a sizable increase in U.S. imports from countries like Vietnam or Taiwan, who are benefiting from the decline in exports from China, you can see at the bottom of the chart. While this has benefited some countries, it's had really more of a negative impact from a global aggregate trade standpoint. And looking to manufacturing PMIs as well, these are often viewed as a sentiment or economic trend indicator. We can actually trace back to the clear point when tariffs became a reality, as we're pointing out back in the summer of 2018, and you can see the subsequent downward trajectory after that. The largest declines for this, we've only plotted 4 economies on this chart, but you could certainly plot many more. The largest declines here would be economies with the largest trade sensitivities, as we're showing with Germany. But I think it's apparent that trade worries have been absorbed into all facets of the market. And finally, tying all of this rhetoric back to actual economic activity in China, this is a look at imports coming into the country. On a year-over-year basis, clearly something had changed. They started posting large declines, which is really a result of the pullback in trade between the U.S. and China, given that the supply chains for those countries are intimately integrated. So yes, this is having a big sentiment impact, but we're also starting to see this in the underlying data, specifically in local China as well. So that concludes the look back of what's happened over the last quarter. As we mentioned in the beginning, feel free to submit any questions that we'll try to address at the end in the lower right-hand portion of the webinar screen. So now Phil's going to walk through our forward-looking views.
Thanks, Jen. So we're going to start with just a quick look at our key market themes. And I think many of you have heard us speak to these before, and at times it's a bit repetitive, but we think this is a good exercise as the path and the disruption associated with each of these themes is really, in our minds, informative and helpful in terms of defining what the global macro outlook is, today and for tomorrow. So we're going to focus on the first two here, what we call late cycle dynamics, and a theme that's frankly a bit impaired at this point, tightening global liquidity. So we'll start with the late cycle. And this is, a repeat from the last quarter. Again, one that's very much important. And a couple things that want to highlight here is when we think about the economic environment, we can very much segment it into different cycles. And the cycles are not equal in duration. Each of the cycles can be different lengths and have different conditions associated with it. And as we assess the market environment, we very much think we're in a late cycle market. And there's a couple of data points that we'd emphasize associated with the late cycle is historically risk assets, equities in particular, have done fairly well across the entirety of kind of quote unquote the late cycle. And really would caution taking big risk down moves that are sizable in absence of really any data that would say there's a recession that's pending. And again, as we look at the kind of conditions of today, we don't really see any material indication that there's a recession that's imminent. I think the other interesting thing about each of these cycles is there's key indicators that you can look to. And each of these indicators kind of give an indication of what's going on within the cycle, and then also are you nearing the end, or is a cycle changing? And this is how we kind of, in a simplistic fashion, view the late cycle. And there's a couple items here that we think are informative, and for the most part, we're very much in what we'd say is a stable late cycle, if that's not a oxymoron in some ways. But when we look at kind of the indicators, for the most part, they're saying, it's very much a late cycle. But there's some key items here that are, almost contradictory. I would say that, potentially maybe this will be a much longer duration of a cycle. So we could see a late cycle that's very long in nature. this is very much anecdotal and not causal, but when we look at the full economic cycle since the last downturn, we've now reached a point where it's the longest in the nation's history. So one could suggest that the late cycle should be equally as long since the other cycles were long. And there's a couple items that we can look to. First, the Fed fund rates. Typically in a late cycle, you see kind of increases in rising Fed funds. As we've indicated here, based on the metric we've used as of end of the quarter, Fed funds have been stable. But when we look to probably action from the Fed next week, we probably see this shift to falling. Second, when we look to the inflation metrics, historically, rising inflation is a sign of kind of a late cycle behavior, and we're seeing inflation, modestly decline from levels at this point last year and from the beginning of the year. And also, you start to see risk getting priced in a bit more in a late cycle, and often that's indicated by rising credit spreads. And we look at today, relative to the last 6 months, we see credit spreads, still coming in. So, not an actionable item here, but we think just helps paint the picture that we're still in a relatively healthy market environment, but one that can very much shift quite a bit from month to month as the market tries to digest what a late cycle means. Again, kind of another theme of ours that's a repeat is tightening global liquidity. We had this slide up last quarter when we walked through it, outlining a theme that is very much challenged or broken, and we wanted to kind of adopt almost a wait and see approach in regards to this theme, just to give kind of a sense of what the Fed likely to do, not just in July, but in the coming months, and what's their outlook going to be. And as we look to see what the Fed is communicating, it seems almost fully baked in that we'll have a rate cut in July coming next week, which would imply that there's clearly some benefit of impairment associated with this theme. But also, when you look at the course of the statements from the Fed over the last 3 to 4 months, whether it's their own projections, whether it's the market expectations, or them announcing that they're going to end the expansion of the balance sheet come end of September. And in some ways, or end of the reduction of the balance sheet, at the end of September. And in some ways, when you look at the mechanics of what the Fed's communicated associated with the balance sheet, they're actually going to be recycling the mortgage bonds at a relatively consistent rate from quarter to quarter. And as they do that, they'll be buying more treasuries. So starting in September, you actually will see the Fed take on an even greater role in terms of their influence on the treasury market relative to maybe what we're at today and over this summer. And so, where this theme ends up over the course of the next quarter, it's still under debate for us, but I think it's fair to say, we're shifting from a period where central banks are clearly tightening and shifting to a more uncertain posture where banks are adopting a more easy bias, but unclear how easy they will go over the next 12 months. And I think the one bout of caution that we also think about when we think about liquidity in the marketplace is we still see issues and constraints within credit markets. And when we think about trading conditions or the underlying trading pipes that exist in the financial sector, clearly some issues remain. And so should we see some real stress in the credit markets, we have big question marks about whether the current market infrastructure can handle a real exodus from crowded credit positions. And just to take another point that Jen has outlined this also, and just to reiterate, when we think about rising rate expectations from the Fed and how that's shifted from where we were at the beginning of the year to where we are now. So current Fed fund rates is in that 225 to 250 range. The blue bar is what market expectations were at December. The light green bar is market expectations in March, and the dark green is where we are at the end of June. And you can see that, just to the left of the 225 to 250, anticipating with, greater than 70% probability that the Fed will cut rates by 25 basis points in July. But also, when you look deeper into the data, not showing here just to keep the chart a little more clean, but when you look over the next 7 to 8 months, there's a greater than 50% chance, according to market expectations, of the Fed cutting 3 times. And as we look at what are market conditions today as we see them, we don't necessarily see a recession coming. And so for market expectation for 3 Fed cuts seems very much a disconnect from what current economic conditions are profiling. And so in some ways, this is the real contradiction that exists within central bank policy. And so in some ways, we're almost at kind of a wait and see approach to see, how these expectations shift over the coming months. And as we see it, we would be very much surprised if we see three cuts over the next 7 months, barring a real downturn in economic indicators. And this disconnect is not always easily digestible by the market. So, the market's shifting from 3 cuts over the next 8 months to no cuts, or just 1 cut in July and no cuts after that. That repricing would have to occur in the market and would have an impact on both equities, rates, and credit markets, and one that in many ways reinforces a late cycle behavior of a bit more volatility. And then to kind of reiterate about the posture of central banks, not just to speak to the Fed, but also talk about the European Central Bank, Mario Draghi, who's going to be stepping off as president of the ECB. When you look to kind of his comments, clearly indicating that inflation is not much of a worry in some ways, and if anything, the biggest worry is getting inflation higher to their affirmed target for inflation, and that additional stimulus in some form is likely to be needed. So in many ways implying that the continuation of existing policy is very much necessary from the European Central Bank, but possibly an expansion in some form of things to come. And as we have, a transition in leadership with, Christine Lagarde taking over, who's the former IMF chairperson, very much, from her public comments, supportive of the current policies from the ECB, but also thinking about, are there other ways that can, other things that measures can be taken to help, boost financial conditions in Europe, and very much aware of the limitations of, how much quantitative easing, how much kind of loan offerings can be done by a central bank, and start thinking to other fiscal measures that may be necessary to help pull Europe out of the malaise that seems to exist today, as we saw with some of Jen's comments as well. So with that kind of is a brief hit on our themes, and we'll highlight some of the change in views that we have from this last quarter. And as we've kind of characteristically done over the last several quarters, categorize them according to what we call our current opportunities. And so this list here is what our current opportunities were last quarter. And we have, one major change that we can see here, which is, removing safe haven fixed income as one of the ideas. And that really is because as we look to how far interest rates have fallen, both this year and the last quarter, we really struggle to see, where there's kind of the additional risk return value of adding, duration for a, total return oriented client. We still see some value in, having, dry powder in a portfolio, but being, thoughtful about how that gets allocated is something we'll be, talking about in a moment. As we look to, our current opportunities as of today, we have 6 currently. We'll only focus on 3 of them, being, reduction to lower quality credit, rebalancing of developed market equities, and our continued view of overweighting emerging market equities. And so as we look to the lower quality credit space, Jen spoke a little bit to, changes in, high yield spreads. This is looking a little bit, deeper into the high yield space. and we can see that, the double B, single B space in high yield now trading below the long-term medians. And really the only aspect that we have seen is not changing materially is in the really low quality space of the high yield market and the triple Cs. But for the most part, most exposure exists in the kind of double B space, and would encourage folks to continue to pare back that credit exposure as should we see, especially if we see high yield spreads go even farther down. But even at current levels, we think the risk return outlook isn't quite there for high yield in the current economic environment. As we look to alternatives, some of that is in this kind of almost dry powder-like space. And as we look to kind of where current yields are, which is the blue bars here, and this is as of 6/30, so still a little bit dated as of now, but relatively informative across the board. You can see there's really not that much value in terms of taking on risk at longer durations or longer maturities across the fixed income space. So as we look to short-term treasuries, even 3-month T-bills, in some ways there's almost greater value in that space as a store of value and a place to store capital as we think about paring back high yield, or even potentially reducing equity should we see equity markets continue to run. And so as we look to the developed market equity space, if we look back to the beginning of the year, we had a call to rebalance developed market equities. But in this case, it was a call to bring up exposures, and for the most part, thinking about it was an opportunity to kind of buy some more U.S. equities, which is sold off following December's downturn, reallocate some of your positions in European equities to redistribute elsewhere, and then we really had just a stellar run to start 2019. And with that, would encourage a bit of a rebalance, out of the developed market space as well. And so we've, slightly tweaked what we'd call our kind of target weight to global equities. The chart here shows the index weight as of December end, and the, text box highlights, what our target weights are, which is, a fairly healthy overweight to emerging market equities, which we'll talk about a bit in a moment. A modest underweight to U.S., but in terms of where we think it makes most sense to kind of take down risk, it's really taking from that EC sector. And, if we kind of drill down even farther, would think, where there's opportunities to pare back some of that European equity exposure. And I think the one thing that kind of would reiterate, relative to kind of the opening comments about the late cycle market environment, is this is a fairly frequent occurrence in the context of the late cycle market environment, where you see rebalancing becoming more frequent, and we would see this likely impacting global equities more than any other asset class, simply because of its volatility, and also where we see valuations today, likely to see rebalancing being more frequent in the U.S., but also in kind of the developed market space and the non-U.S. developed space. And I think for some that have maybe a higher tolerance for dynamic shifts, or kind of greater tracking error bands in terms of how they think about their portfolio, there's some space here we think to maybe think about reducing total equity exposure. Because look at what the markets have done to start the year. It's really been a great year, and to the extent that paring back a little bit of that total equity exposure, whether that's doable, and if that makes sense for some, thinking about kind of putting that into kind of the dry powder, quote unquote dry powder space with some of the short term safe haven fixed income options that may exist. And last but not least is thinking about the emerging market space. Continuing our view that having an overweight position in EM makes sense, and part of this almost requires us to have a view that we believe that there's some form of a trade resolution that's going to occur between U.S. and China. Also one that we very much question ourselves frequently, but one that we do believe. And so as negotiations pick up again, as maybe the election season in the U.S. starts to pick up and become a little more intense, we see the potential for negotiations to reach some sort of agreement between U.S. and China in terms of trade reaching a point that, if we can have an agreement, likely lifts very much of what's been a stiff headwind for EM equities, and allows them to maybe run a bit where we see fundamentals today still look fairly attractive, whether it's on an equity basis or currency basis. We think this is the space to be taking, essentially, the risk budget for overweight or dynamic views. And so that's the conclusion to our prepared comments. So if I maybe take a moment for questions that we may have. And so maybe just for the first one, maybe to throw to Jen, is maybe talk a little bit about the changing dynamics of the global economic growth outlook from the IMF. You have an update here from where we saw rates in moving from April to July in terms of growth rates. Maybe talk a little bit about the change from Q1 to Q2 and just some thoughts that you might have on that.
Yeah, sure. So I pulled that slide back up, and as I mentioned, these July numbers came out this morning, and after reading through a lot of the IMF's commentary, it seems like they were unfairly harsh against the US and really Europe too, at the end of last year, in thinking that a lot of the strong economic momentum they had would be more heavily impacted by trade, and surprise to the upside really for developed economies so far this year. I think as far as if you had done this chart, for example, from December to July, there really aren't that many changes. I think directionally, aside from the US, everything is lower, which kind of makes sense given some of the comments we made before. But I do agree that the US being slightly higher than maybe last year is probably at least an initial shock to those looking at this.
Great. Thanks, Jen. Before we started the webinar, Jen and I flipped a coin to see who would take the Brexit question. So we knew that would come up with what looks like Boris Johnson assuming the leadership role in the UK. Unfortunately, I lost. So I'll speak a bit on the impact of that. And I'd say one thing is, when we think back to our key market themes, one aspect that we didn't talk about today in much detail, but in regards to Brexit, is it very much fits in our view of kind of a globalization backlash. So there's an aspect of populism that's a part of this, and there's also an aspect of kind of pulling back from global integration. So that might be from trade or more multilateral agreements. And we've always thought of Brexit as in many ways the perfect case study for our globalization backlash view. And it's one where we're kind of slowly watching it play out, and clearly it's having a bit of an impact from an economic growth standpoint on the UK, and also maybe even sentiment for Western Europe and the UK. But still a bit inconclusive in terms of what's its impact from an investable market standpoint. And as we look to comments from Boris, essentially implying that regardless of what happens over the next couple months, October is the final deadline for Brexit. There'll probably be a bit more volatility in the space associated with that. And I think as we think about Brexit's impact on the greater European continent, I think that's where you see some of our more negative views of Europe seep in. But I think the one thing we've learned is to trying to over extrapolate how the market will digest these things is very difficult. Because remember, after the initial Brexit vote or the referendum, the pound sold off quite dramatically, but also local equity markets in the UK have hit new records 90 days after. And I think a similar dynamic probably could be at play, where we've always thought these real kind of political risks or kind of the risk associated with globalization backlash usually come most acutely in the form of currency volatility, and we would expect sterling to very much feel that in the coming months and maybe even the coming years. I think overall, the impact of the UK on the global economy is relatively small, but clearly has a sentiment factor in terms of how investors think about kind of the risk outlook for the world. I think we got one more question in regards to credit, and so maybe just to segment this into two parts. When we think about credit markets today, and maybe for Jen to think about kind of reiterate our views in the public credit markets, how does the leveraged loan outlook, how does some of the lower quality credit space fit in with our view of high yield? Is it still one that's similar, or do you see differentiation in terms of our view of reducing lower quality credit?
I think they're relatively similar at this point. I would say if you think about this in the context of our late cycle theme, as we think about potentially the U.S. economy kind of moving along that path toward a recession eventually, that would suggest higher defaults and potentially lower recovery rates going forward. So I think that's kind of where our head's at as far as lower quality credit, and you're also not really being compensated for taking that type of risk in public markets at this time.
And the second half of that question is, how does our outlook on private markets change in terms of the credit space? I'd say one, as we look to kind of the U.S. direct lending market, definitely some question marks starting to creep up just in terms of underwriting standards and rates that we're getting in that space. And then the other side of that is, what do we like to see in terms of defaults should the economic cycle turn? So from a broad firm perspective, or kind of as our credit beta group has outlined, they shifted to a bit more negative view on direct lending in the U.S. And some question marks starting to come up with direct lending space outside of the U.S. But maybe a little bit behind in terms of the U.S. in terms of the transition of that view from what many years ago was positive to more neutral to down the line maybe transitioning to more negative outlook. And I think the one thing that other aspect that we've looked to is we don't see the distressed market coming up as an opportunity today, but to start thinking about and prepping for next year, 2 years, 3 years out for distressed opportunities that might start to pop up, which would be characteristic of a late cycle market. So I think if anything, as we look to private credit, looking to real idiosyncratic opportunities, and to the extent that they do come up, keeping an eye on potential distressed opportunities. And a question for Jen, what are your thoughts on MLPs? Maybe just reiterate kind of what's our view on MLPs and the thesis behind that, which really is in some ways kind of a 2 to 3 year view in terms of where we see the MLP landscape evolving.
Yeah, sure. So one of our current opportunities that we hadn't highlighted today is fund public midstream energy exposure. And this was something that we had added, I think, about a year ago, maybe a little more now, after the space had gotten beat down pretty heavily as MLPs were transitioning to C Corps and trying to clean up their balance sheets, among other things. So we looked pretty hard into the space and saw that there was a pretty attractive asset that was out of favor in the market and still had a really nice dividend yield associated with it. And we ended up adding this, and so far this year, midstream energy has done quite well, but we think there's still a lot of upside potential in the space, particularly as a lot of these companies, like I mentioned, have cleaned up their balance sheet, and the long-term opportunity set kind of still holds. So we're still excited about that and expect it to be on this list for the time being.
Great. Thank you, Jen. So with that, that's all the questions that we received. So, thank you everyone that joined us, and thank you for listening in. Just as a reminder, these slides and the recording will be sent out tomorrow and also posted on our website at NEPC Insights, is where you'll be able to find that and other, other writings that we've had, whether it's market thoughts or our blog, Taking Stock. So please, take a view if you got a chance to spend through that. And with that, thank you all for joining, and this will be it. Thank you.
Thank you.